Most couples heading into retirement believe they've already survived the hardest financial years of their lives. They worked for decades, paid taxes for decades, slowly built retirement accounts over time, and somewhere along the way many couples assume the system finally becomes simpler after retirement, but for millions of Americans. One of the most financially dangerous moments actually begins after a spouse passes away. The reason catches surviving spouses completely off guard because the IRS does not treat a surviving spouse the same way it treats a married couple. In fact, the tax system can change almost overnight. What used to be a comfortable retirement income can suddenly trigger higher tax brackets, larger Medicare premiums, and much heavier taxation on retirement withdrawals. Financial planners sometimes call this the widow's penalty, and in many cases retirees don't discover it until it's already happening. Here's why this matters so much. Imagine a retired couple living mostly from Social Security, IRA withdrawals, and investment income. While both spouses are alive, they file jointly. The tax brackets are wider, the thresholds are more forgiving, the Medicare income limits are easier to stay under. Then one spouse passes away. The surviving spouse now files as a single taxpayer, but the income often doesn't drop by 50%, and that creates the trap. The exact same retirement income that once fit comfortably inside a married tax bracket can suddenly push the surviving spouse into a much higher bracket entirely. That means more taxes on IRA withdrawals, more taxes on Social Security, potentially higher capital gains taxes, and in some cases significantly higher Medicare IRMA surcharges. Many retirees spend decades building retirement accounts without realizing the real tax problem may not appear until one spouse is gone, and this becomes especially dangerous with 4 specific asset types because these assets often look perfectly safe while both spouses are alive, but after the first death, the tax treatment can change. Dramatically, some families unknowingly lose tens of thousands of dollars simply because they waited too long to reposition these accounts. Now, to be clear, this is not about panic, and it's not about moving assets illegally or hiding money from the IRS. This is about understanding how the rules work before timing removes your options, because once certain tax deadlines arrive, many strategies disappear permanently. In this video, we're going to break down the 4 major assets retirees should carefully review before a spouse passes away, why these accounts become dangerous later in retirement, and what many financial professionals quietly recommend doing before the tax burden shifts entirely onto one surviving spouse. And the 4th asset may be the most dangerous of all because millions of retirees hold it without realizing how aggressively it can be taxed later. The first asset retirees often need to review is the traditional IRA or traditional 401k, and this is where many surviving spouses run directly into the largest tax surprise. For years, traditional retirement accounts grow tax-deferred. That sounds beneficial while working because contributions may reduce taxable income upfront, but eventually the IRS wants its share, and after age 73 required minimum distributions begin. That means retirees can no longer choose whether to withdraw money because the government forces taxable withdrawals every single year. While both spouses are alive and filing jointly, those withdrawals may remain manageable from a tax perspective, but after one spouse passes away, the surviving spouse often keeps nearly the same retirement accounts while losing the protection of the married filing jointly tax brackets. This is where the math changes fast. A surviving spouse may suddenly find themselves pushed into a higher tax bracket despite household income actually falling. At the same time, Social Security taxation can increase because more income becomes exposed under single filer thresholds, and Medicare premiums may rise too. Many retirees don't realize Medicare uses income from prior tax returns to determine IRMA surcharges. So a large IRA withdrawal after a spouse passes away can increase Medicare costs years later. This creates what financial planners sometimes describe as a retirement tax chain reaction where one withdrawal affects another threshold, one threshold affects another penalty, and suddenly the surviving spouse keeps far less income than expected. This is why many retirement strategists discuss Roth conversions before the first spouse passes away. A Roth conversion means voluntarily moving portions of traditional IRA money into a Roth IRA while both spouses are still alive and filing jointly. Yes, taxes are paid during the conversion, but many retirees intentionally pay taxes earlier at lower joint rates to potentially avoid much larger taxes later under single filer rates. This strategy is highly individualized and depends on income, age, future tax expectations, and estate goals. But the key point is timing because once one spouse passes away, the tax flexibility often shrinks dramatically, and retirees who delayed planning sometimes discover they no longer have enough room to reposition assets efficiently. The second dangerous asset category involves taxable brokerage accounts with large unrealized capital gains. Many retirees assume investment gains are only a problem when selling assets, but surviving spouses can face difficult decisions later if they suddenly need liquidity, downsizing funds, or long-term care expenses. A large stock sale could trigger significant capital gains taxes while also increasing Medicare premium calculations, and because tax brackets narrow for single filers, the impact may arrive faster than expected. This is why some retirees begin gradually reviewing appreciated investments years earlier instead of waiting for a financial emergency later in life, because in retirement planning the biggest danger is often not the asset itself, it's losing the ability to control the timing. The third asset retirees often overlook is the family home, and this surprises many people because they assume a paid-off house automatically protects them financially later in retirement. But after one spouse passes away, the financial picture surrounding the home can change quickly. In some cases, the surviving spouse may eventually decide to downsize, move closer to children, or transition into assisted living, and that's where hidden tax consequences can begin appearing, while married couples may qualify for up to a $500,000 capital gains exclusion when selling a primary residence. Single filers generally receive only a $250,000 exclusion. That means timing matters enormously. Imagine a couple who bought a home decades ago for $180,000 that is now worth $900,000. While both spouses are alive, a large portion of that appreciation may remain shielded under the married exclusion rules, but after one spouse passes away, waiting too long to sell could expose much more of the gain to taxation if the surviving spouse later sells alone, and many retirees never realize this window exists. At the same time, property taxes, maintenance costs, insurance premiums, and healthcare needs may continue rising for the surviving spouse even as household support declines. This creates emotional pressure at exactly the wrong time. Some surviving spouses end up making rushed financial decisions simply because they were never warned how quickly the rules could shift after losing a partner. There's another layer many families miss entirely: inherited cost basis rules. In community property states, surviving spouses may sometimes receive a full step up in basis on appreciated assets. While in non-community property states, the rules can differ significantly, and understanding how those basis adjustments work can dramatically affect future taxes owed when assets are eventually sold. Again, this is why proactive planning matters long before a crisis happens, because once a spouse passes away, many financial choices become reactive instead of strategic. Now let's talk about the fourth asset category, and this may be the most dangerous for retirees who built substantial savings over decades. Large cash reserves sitting inside CDs, money market accounts, or savings accounts. At first glance, cash feels safe because there's no market volatility, no investment risk, and no complicated statements. But large cash positions can quietly create serious long-term retirement problems because inflation slowly erodes purchasing power every single year. Meanwhile, retirees often generate taxable interest income while receiving very little real growth after inflation and taxes are considered. And after a spouse passes away, the surviving spouse may suddenly face higher taxes on interest income due to narrower single-filer thresholds. This becomes even more dangerous if required minimum distributions from retirement accounts are also increasing simultaneously. Now the surviving spouse has taxable IRA withdrawals, taxable Social Security exposure, taxable investment income, and taxable interest income all stacking together. That stacking effect is what catches retirees off guard. Not one giant mistake, but multiple smaller tax pressures hitting at the same time. So what do experienced retirement planners often focus on before these problems appear? They focus on reducing future tax concentration because many retirees unknowingly store the majority of their wealth inside accounts the IRS has future claims on, such as traditional IRAs, traditional 401ks, deferred retirement income, and taxable withdrawals. The longer those balances grow, the larger future required minimum distributions can become. That's why some retirees intentionally begin repositioning assets years before major retirement deadlines arrive. For example, some households gradually convert portions of traditional IRA balances into Roth accounts over time instead of waiting until required minimum distributions force larger withdrawals later. Others begin carefully managing capital gains while both spouses are alive, and filing jointly to potentially take advantage of lower thresholds. Some review trust structures, others review beneficiary designations, and many retirees discover their current estate setup no longer matches today's tax laws. One of the biggest misconceptions in retirement planning is believing taxes only matter when income is high, but retirement taxes often become dangerous because thresholds remain frozen while account balances continue growing. That means even moderate retirees can gradually drift into higher taxation zones over time without realizing it, and after one spouse passes away, that drift can accelerate quickly. This is also where Social Security taxation becomes more painful. Many Americans assume Social Security is mostly tax-free, but depending on combined income levels, up to 85% of Social Security benefits can become taxable, and once filing status changes from married to single, retirees may cross those thresholds much faster than expected. This later, so retirees are not just managing taxes today, they're managing future healthcare costs tied to income calculations as well. This is why retirement planning becomes less about chasing returns and more about controlling timing of withdrawals, timing of conversions, timing of asset sales, and timing of income recognition. Because once a spouse passes away, flexibility often shrinks dramatically. And unfortunately, many families only discover these rules after they've already entered the higher tax environment. The goal is not eliminating taxes completely because that's unrealistic. The real goal is preventing unnecessary taxation caused by poor timing and lack of preparation, and retirees who understand that distinction early often preserve significantly more wealth over the long run, especially during the most financially vulnerable years of retirement. One of the most difficult parts of retirement planning is that many of these financial risks remain invisible while life feels stable. When both spouses are healthy, living together, and managing finances jointly, it's easy to assume the current system will continue indefinitely, but retirement planning is really about preparing for transitions before they happen, and the transition from married filing jointly to single filer status may be one of the largest financial shifts many retirees ever experience. What makes this especially dangerous is the emotional timing. The surviving spouse is often grieving, overwhelmed, and suddenly responsible for financial decisions they may never have handled alone before. At the exact moment clarity matters most, stress is usually highest, and that's why many costly mistakes happen during this period. Some retirees begin taking larger withdrawals than necessary. Others sell investments too quickly. Some trigger avoidable capital gains taxes, others unknowingly increase Medicare premiums for future years, and many simply delay planning because they assume they still have time. But in retirement planning, waiting often removes options. This becomes particularly important for beneficiaries as well because under newer inherited IRA rules, many non-spouse beneficiaries now face accelerated withdrawal requirements that can compress taxes into shorter timeframes. So retirement accounts passed to children may create tax burdens families never expected. That's why many retirees are now reviewing Roth conversion strategies, trust structures, beneficiary designations, withdrawal sequencing, and estate planning coordination, not because they expect disaster tomorrow, but because proactive planning creates flexibility later. And flexibility is incredibly valuable in retirement, especially when laws, tax brackets, healthcare costs, and family circumstances continue changing over time. No single strategy works for everyone. Some retirees benefit from gradual Roth conversions, while others prioritize charitable giving strategies. Some focus on preserving liquidity, while others focus on minimizing future required minimum distributions. The correct approach depends on total assets, age, income sources, marital status, healthcare expectations, and long-term estate goals, but nearly every retirement professional agrees on one thing. The earlier these conversations happen, the more options retirees usually have because once deadlines pass, many strategies become far harder to implement efficiently. Unfortunately, millions of Americans spend decades building wealth without realizing how aggressively timing can affect retirement taxation later in life, especially after the loss of a spouse. That's why reviewing these 4 asset categories before major life transitions occur can be one of the most important financial conversations retirees ever have. At the end of the day, the biggest retirement risk for many Americans is not market volatility. It's hidden tax exposure created by timing, and few situations expose that risk faster than the loss of a spouse because the tax system changes quickly. The brackets narrow, the thresholds tighten, the Medicare calculations shift, and retirement accounts that once seemed perfectly manageable can suddenly become far more expensive to withdraw from. That's why so many retirees are now focusing less on simply growing wealth and more on protecting it efficiently. They want flexibility, control, predictability, and most importantly, they want to avoid making irreversible mistakes too late. This does not mean retirees should panic and start moving assets recklessly because retirement planning works best when decisions are thoughtful, coordinated, and personalized, but it does mean understanding where future tax pressure may come from before options disappear because once required minimum distributions begin, once filing status changes, and once large account balances continue compounding for years, the planning window often becomes much smaller. This is exactly why many financial professionals encourage retirees to begin reviewing IRA balances, Roth conversion opportunities, taxable investment gains, home equity timing, beneficiary structures, and estate coordination plans long before major life transitions occur, not because disaster is guaranteed, but because preparation creates choices, and in retirement choices matter, especially for surviving spouses trying to preserve financial stability after losing a lifelong partner. The families who navigate these transitions best are usually not the ones who made perfect predictions. They're the ones who prepared early enough to stay flexible, and that flexibility can potentially save tens of thousands of dollars over the course of retirement. So if you're approaching retirement, already retired, or helping aging parents manage long-term financial decisions, now may be the time to review how your assets are structured before future tax rules make those decisions much harder because many retirees spend their entire lives building wealth only to discover too late that the real challenge was protecting it after the rules changed, and in the years ahead these retirement tax issues are likely becoming even more important as required minimum distribution rules, healthcare costs, and federal tax pressures continue evolving. That's why understanding these hidden retirement traps today could become one of the most valuable financial decisions you make for the future. And if you want to continue learning about retirement protection strategies, hidden IRS rules, Social Security taxation, and the financial traps many retirees never see coming, make sure you subscribe to Michael Retires Shield for future breakdowns and retirement warning updates.